What is going on, guys? This is Lucas again. In this video, I will show you a way to use leverage to generate extra return, or alpha, to beat the market and make extra money. The key of this method are twofold. First, the leverage is adjusted dynamically. That is, we will apply different levels of leverage under different market conditions to maximize our return. The second key is that the method will help us to stay disciplined. Discipline is absolutely crucial for the use of leverage in the long run. As a result, the method will help us generate consistent extra return on our money. Without further delay, let's look into the details of the method. The dynamic adjustment is based on volatility, which is relatively easier to predict than stock market returns.
We will use the VIX index, the so-called VIX index, to measure the volatility of the market.
And the idea is to leverage less when VIX increases. And vice versa, to leverage more when the VIX decreases. As you can see from the blue curve. In my portfolio, I just set the level of leverage to be inversely proportional to the index. In practice, I also cap my maximum leverage at 25% as shown by the green line. Of course, you can set a different maximum level that suits your own risk tolerance level. The point is that you have to set a limit and you stay disciplined within that limit. As already mentioned, discipline is absolutely crucial for the use of leverage in the long run. This idea of using more leverage when volatility is low has been thoroughly discussed. For example, you can see this following article. The title of the article is Alpha Generation and Risk Smoothing Using Managed Volatility. And the authors is Tony Cooper. You can see discussions of the specifics of this idea and we won't further elaborate them here. Here, let's just directly the results and how this idea actually work. This is a key chart. It is taken from Tony Cooper's article as just mentioned. This chart shows the test results of the above idea with more than 100 years worth of daily U.S. stock index prices. The horizontal axis shows the leverage used and the vertical axis shows the compound annual percentage return. The orange circles show the popular leverage rates of 1, 2, 3.
They are popular because these are the ETF funds that you can easily trade.
There is nothing magic about the leverage value 1.
It is just an unleveraged ETF fund by itself.
And as you can see, without any leveraged, the average annual return is about 4%. Note the return we quote here is only the capital appreciation. That is, the dividends are excluded. You can also see, as you increase the leverage from 1, it increases the annualized return. For example, increasing the leverage 2 would generate an average annualized return of about 5%. Do not overlook the extra alpha of 1%. 1 more percent of compounding rate over the long run can create financial miracles. But then, you cannot overdo it. Further increasing the leverage will begin to hurt performance. For example, when leverage is increased to 3, the annualized return is actually lower. This is caused by something called volatility drag. Let's not get distracted and go into the details of this concept. For readers interested about the volatility drag, please let a comment and I will respond there. To summarize, the takeaway is that a proper level of leverage helps to create additional alpha in the long run. This chart shows the performance of our leveraged model portfolio over 15 years or so. The performance of the aggressive portfolio is shown by the blue line since 2006. And the performance of the overall market, the S&P 500 index, is shown by the red line. As seen, the performance is compared during a 15-year period, from 2006 to 2020. And the leveraged portfolio outperformed the S&P 500 index most of the time. It really took off and began to dominate the S&P 500 index shortly after the 2008 Great Crash was over. In terms of dollar amounts, The aggressive portfolio outperformed the overall market almost by more than 200% in the past 15 years. For $10,000 invested in the overall market, it has grown to $30,000, not that bad. However, our aggressive portfolio has growth more than six-fold, to almost $65,000. Truly impressive. Again, this portfolio is our real portfolio. And we adjusted it monthly. The returns included dividend reinvest. We will update it and discuss more details in our future videos. This chart shows the specific funds used in our leveraged portfolio. As you can see, the leveraged portfolio is a variation of Ray Dalio's all-weather portfolio. It includes the following asset classes: long-term treasuries bonds, intermediate-term treasuries bonds, gold, and stocks. The stocks are where the leverage is applied. The stocks include overall market stock funds such as VTI.
It also uses specificity fund like the biotechnology funds, X, B, I, to grow more aggressively.
It also includes more individual stocks we picked for their long-term return potential.
And finally, it applies the target leverage by the ProShares Ultra Pro Q fund. Ticker number, TQQQ.
It is a leverage fund that provides 3 times leveraged exposure on a daily basis to NASDAQ 100 index. So if the NASDAQ 100 index goes up 1% today, it will go up 3%. And vice versa. When NASDAQ 100 goes down 1%, it goes down 3%.
Sometimes, we also see EF funds, closed-end fund to add leverage. By adjusting the relative weights of the TQQQ fund and CEF funds, we can tailor the level of leverage to the target level as mentioned earlier.
And as shown earlier also ready, such dynamic and disciplined application of leverage helps us to generate alpha consistently and beat the overall market by a good margin in the long term. The annualized return for the leverage portfolio is about 14.5% during this period of time. And the S&P 500 index's return is only about 8% annualized. As to be seen next, thanks to the proper diversification and disciplined approach, the portfolio actually fluctuates less than the overall market despite the leverage used. The table below provides a more detailed look and it compares the leveraged model versus the overall market in more details, including the annual return, worst year performance, drawdown, and so on. First is seen, the annualized return for the leverage portfolio is about 14.5% during this period of time as mentioned before. And also as mentioned before, the S&P 500 index's return is only about 8% annualized. As we look deeper into the comparison, we will see that the leveraged portfolio produced such superior return without taking extra risks. It actually suffered lower risks. As measured by standard deviation, the leverage portfolio suffered on average 10.8% of standard deviation, versus more than 15% from the S&P 500 index. In terms of worst year loss, the leverage portfolio suffered a worst loss of 12.8% during this period of time, versus more than 37% from the S&P 500 index. And in terms of maximum drawn down, it suffered a maximum drawdown of 30.6% during this period of time, versus more than 50% from the S&P 500 index. More than 20% less. This is a lot. Think about the worst times, seeing a 20% less decline of your total asset is worth a lot, both in economic terms and emotional terms. This is a portfolio that we actually use to manage a large part of our family assets. And we update the portfolio composition on a monthly basis. Here is the portfolio composition as of November the 15th, 2021. As you can see, the portfolio as of now consists of the following components. First, intermediate term Treasury bond 17%. Second, long-term Treasury bond 21.7%. Third, gold, 9%. Fourth, unleveraged stocks 43.6%. And finally, the leveraged stocks at 8.7%.
By adjusting the relative weights of the T, Q, Q fund and C, E, F funds, we can tailor the level of leverage to the target level as mentioned earlier.
And we will provide monthly updates of our holdings if you want to follow and monitor this portfolio. This chart shows the weight of the leveraged stocks in the portfolio. And as you can see, the leverage indeed changes dynamically over time as the market condition changes. And again, we will provide regular update of the leverage we use in the future. This chart shows the performance of our leverage portfolio on a weekly basis since May 2021. The leverage model portfolio is shown by the blue line.
The leveraged portfolio performance is benchmarked against the Vanguard Total Stock Market ETF, VTI. It is shown by the red line. The VTI fund is used to represent the overall market.
This has been a really short time compared to our investment time horizon, and then there is no need to read too much into the specific numbers. But as seen, the leveraged portfolio has been leading the overall market most of the time over the past 6 months.
But it currently is lagging VTI by a small margin.
At their current level, plus or minus 1 or 2%, the numbers can all change within a day of random market fluctuation. However, the data does provide a peek into the fundamental advantage of the leveraged portfolio. As seen again, thanks to the proper diversification and disciplined leverage, the portfolio actually fluctuates less than the overall market even with the leverage. Same as the results over long periods as provided earlier. With that, hope you've enjoyed the video and we will wrap up here. To summarize and recap, the use of leverage in a dynamic and disciplined way can generate extra return and beat the market. The first key is to adjust it dynamically under different market conditions to maximize our return. The second key is to stay disciplined. Discipline is absolutely crucial for the use of leverage in the long run. And finally, portfolio updates will be provided regularly in case you want to monitor and follow this leveraged portfolio. Thanks for watching and see you next time.